one of the rationales for introducing IFRS 17 was obviously the different approaches that insurers were taking, and that's making it hard for investors and shareholders to understand the relative performance of different insurance companies. So one of the key drivers of IFRS 17 is to standardize that. So shareholder returns and how they're perceived will be a very important post IFRS 17. And IFRS 17 is going to impact the profit, the IFRS, the accounting profit, in a very big way. Obviously, there's a lot of change in definition, but this CSM is fundamentally changing the profit recognition of insurers. So the metrics, I think, will still be the same. So you'll still have operating profit, adjusted operating profit, but the values will be very different. And that will be the case on transition in particular, when the profit recognized to date will obviously change significantly, and then going forward as well. So I think the metrics will be very similar to today, but there'll be a lot of requirement to understand what's happened on transition, and then going forward, how do insurers communicate their profitability going forward, given that profit will be locked up in this new metric, the CSM. So a lot of the ratios, combined ratio, expense ratio, these will stay the same. So IFRS 17 is not going to significantly change the definition of these metrics, but they're the way that people are used to looking at the business, particularly management teams. So I think it's a good idea to imagine continuing to use those metrics. So useful to bake into your solution the calculations supporting those metrics and creating those links to your IFRS 17 numbers. But I think what will happen over time is some of the IFRS 17 ratios will start to come into play. For example, insurance service margin. The new business value is a commonly used metric. I think people will want to see measures for new business and the value that is creating in the company. But I think what will happen quickly is that the CSM will become a measure of that, because the CSM is a very good measure of the profitability of new business acquired. That's measured on initial recognition. So I would expect to see insurers moving to measure new business using the CSM. So return on assets is going to be very important. It's not covered by IFRS 17, but along with the implementation of IFRS 17, insurers have to adopt IFRS 9. So as part of your IFRS 17 solution, you might want to think about integrating your IFRS 9 program and consolidating the asset view with the liability view. So cash is cash, accounting doesn't change that. So all the metrics around cash will continue as before, but again, the level of granularity in IFRS 17 is different. So you might want to cut some of those metrics in the new units of account. So having an integrated cash view in your IFRS 17 solution will be important. And then finally, we have some of the simpler metrics like gross written premium that I think it would be useful to incorporate into your overall design, so that when you're reporting your accounting measures under IFRS 17, you can continue to report these kind of metrics that people are familiar with. So as Jeremy mentioned, reporting isn't straightforward. There's more than one way information can be accessed and viewed. So in Legerity FastPost, we have a whole range of screens that you can use to query balances, transactions, and we have some graphical and tabular views. We support that with data extract, so there's a lot of rich information inside the tool, but inevitably finance actuarial teams will want to take data out for ad hoc analysis and other reporting. And then the end target is the disclosures. So the IFRS 17 is quite prescriptive in terms of what needs to be included in these. They need to be in particular formats. So as part of our solution, we've pre-built the full set of disclosure templates that you want. And I think what's important to note is they're not static reports, they're dynamic reports. So you can drill into these disclosures for different entities and portfolios. So that will be an important aspect of your disclosures to make sure you have that drill down. And then finally, the main focus of our webinar today is around how you can leverage BI tools. So BI tools are great for data visualization and drill down and creating dynamic views of the information. So a range of tools that we offer for as part of our solution. And we'll see different groups of people focusing in on different types. So the financial controller and financial analysts will obviously use the screens. They'll be interested in checking balances and transactions, and obviously making sure that the underlying process is delivering the correct numbers. Data extracts will be used by analysts in the finance and commercial teams, where they'll be looking at ad hoc queries, potentially supporting business cases and all that sort of day-to-day detailed work in the company. The disclosures will obviously be presented by the CFO, but the controller and the analyst will need to support the CFO in terms of briefing, and that's where the sort of drill down capability on the disclosures will be very important, and the ability to link the information in the disclosures to your extracts, your screens, and your BI tools. So we see the BI tools as probably the most widely used reporting delivery mechanism. So dashboards all the way from the CEO talking to his investors and shareholders, CFO again briefing external and internal stakeholders, and then the team supporting them in terms of the controller and the analysts, and extending that information out into the wider company. So what we might want to do in the fullness of time is add on some of the additional complications, say around insurance finance expenses. That'll be an important area, and a lot of decisions will be made during implementation that will have a big effect on profitability. OCI disaggregation, for example, so monitoring the effects of choices like that. Hedging, IFRS 17 has some particular rules on hedging, so you could incorporate from your other areas of the business information together to understand properly the impacts of hedging on your numbers. And as we talked about IFRS 9, so bringing together the asset and the liability view is all possible once you've consolidated that in the subledger. And a very big topic, obviously, which you haven't really touched on, is reinsurance, but all the reinsurance groups are accounted for in Legerity, and so therefore you can use those segments to create reinsurance levels of aggregation to start looking at portfolios and lines of business with and without the reinsurance cover. So for the purposes of this short demonstration, obviously we focused on the simpler metrics to get the main points across, but obviously in the full project you might want to think about introducing these other more complex areas and bringing that information together in the subledger.